A contributes cash. Say 50 grand. And B contributes property. Fair market value 50, basis in his hands of 24. This property was inventory in B's hands. Two years later, the partnership sells the property for 100 grand. Who wants to take a crack at that one? I'm volunteering. First question I have for you: does the facts of that case raise any of these items here in 1 through 5?
Yeah,
3. Okay, and you say that because why?
Inventory on the partner's hand.
It was, see, unlike the previous problem where it was inventory in the partnership's hands, this is contributed property that was inventory in B's hands, the partner. So 3 applies. Now, there's another thing that you have to determine whether 724B applies. What's that? In addition to what you just said.
The time element.
The time element. Okay, what's the time element?
Yeah.
The property was contributed less than 5 years ago, prior to the sale. So bingo, all the elements of there would trigger 724B. And when 724B is triggered, the consequence is?
Ordinary capital, but in this case, it would be ordinary.
Correct. What if he had sold this property? So this, in this scenario, it's ordinary income to the partnership. Okay. What if he had sold it 7 years later?
Capital.
Then it could be capital.
Capital.
Why? Because 724B only applies to sales up to 5 years after date of contribution. Everybody with me on that? Right? So, for purposes of our analysis for the rest of it, what are the tax consequences to the partnership and the partners, assuming the sale is 7 years later? Oh, by the way, the partnership, this asset is investment property, not inventory, in the partnership's hands. The exact reverse facts of the previous problem. Okay? obviously, if this property was inventory in the partnership's hands also, it would be ordinary income. And 724 would almost be irrelevant, okay? But this property is investment property in the hands of the partnership. Now they wait 7 years to sell it. What's the consequence of that? First of all, does B have a pre-contribution gain?
Yes, 26.
B has a pre-contribution gain of how much?
26. Is that 450 or 50 for market value?
50 and 24.
Okay, so 26.
So what's the pre-contribution gain?
26.
Are you guys falling asleep on me? 26?
26.
And that goes all to whom?
B.
To B. Now, the none of that $26,000 goes to A. Now the post-contribution gain is 50. Here's the total for all partners. Here's partner A, here's partner B. So we have a total gain of how much? You sold it for 100, its basis is 24, so the total gain is 76, right? That's the total gain. Does everybody see where I got that? 100,000 was the selling price, less the basis of 24. Okay? So now we have $50,000 of post-contribution gain. This is pre, this is post. The pre all goes to B because he contributed the property. And the remaining 25 is that right? Yeah. 24 minus 100. Yeah. 76. So the remaining 25,000 is split this way. So everybody see that? So B is going to pick up 51,000 of gain on this sale. A is going to only pick up 25. We mean pre-contribution gains have to be allocated to the partner who contributed the property. Okay, that's nothing new. We've seen that in a number of other examples. Now the only question is, what is the character? If the property was sold 7 years later, what is the character? It's all capital. 7 years later, it's all capital. Why? Can you tell me why?
Well, number one, there's no timeline, and
Well, yeah, there is a time length, but it's 5 years.
oh, okay, I was looking at the wrong one. Oh, so
This is not receivables, this is inventory,
okay,
okay?
so then it's
But
past the
5 years is less than 7. So because they held it for more than 5 years, 724B does not apply. Now, what if it was sold 2 years?
Ordinary.
How much of it is ordinary? All of it or just part of it?
The pre-contribution.
There's the word, all. Make sure that's correct. That's 724B. Any gain or loss recognized by the partnership during the 5-year period shall be treated as ordinary. So it's all ordinary. If you sell it within that 5-year window, you gotta wait till it's old and cold and sell it more than 5 years later. So there'll be capital here, ordinary there. Any questions on that? All right, let's move on. Hopefully these questions will be a bit easier. Okay, let's start right here. If you acquire your partnership interest by gift, where the donor is alive, yes.
Oh, sorry.
You acquire your partnership interest by gift. Let's say I give you a partnership interest while I'm alive. Inter vivos gift, as we say in the law. As opposed to a testamentary gift is when I give you something in my will. Okay? What is your basis in your partnership interest if you acquire it from me by gift? What are you gonna look to?
Will be the basis?
I'm sorry?
The basis? Right.
Yeah, the basis in the partnership interest.
Mhm.
I give you my partnership interest while I'm alive. How are you gonna determine your basis?
Fair market value?
I told you it was an inter vivos gift, not a testamentary gift. Namely, it's a gift while I'm alive. Think back to tax 1. If you acquire property by gift, what's your basis? The donee's basis is the same as the donor's. Now, if you inherit the property at death as a testamentary gift, then you're correct, it's fair market value at date of death. That's not what I asked you. I asked you, what is your basis if the donor is alive when he gives you the gift? We just said it. The donor's basis becomes the donee's basis. The donee is the person who receives the gift, the donor is the person who gives the gift. Okay? Clear? All right. True or false? A Section 754 election. You know what a Section 754 election is? Let me give you here's the true or false statement, okay? A Section 754 election is usually made by a partner who purchases his partnership interest from another partner, and the assets of that partnership have appreciated in value since the time the selling partner acquired his partnership interest. True statement?
I feel like it's the right scenario where but I'm not sure if it's.
Okay.
cheaper or if it's
Who can help her out? What does a 754 election do?
It allows you to take depreciation at a higher basis, or no, wait, the lower basis. The higher.
Put the depreciation, first of all, what you said is true, but put the depreciation issue aside.
Okay,
What does the 754 election allow you to do?
it allows you to take a higher basis as a partner in the partnership.
In the partnership, what?
Interest.
The partnership interest, the partnership assets.
Okay,
You get to step up your basis to what you paid for your partnership interest. You bought my partnership interest for $100,000 cash, but all I am is an accounting firm with beat up desks and chairs that are worth 2 cents. You'd be able to step up the basis of those assets to what you paid for it, so that you could depreciate or amortize. If you're buying an accounting firm, what are you basically buying? You're buying the goodwill of the clients, which you can amortize over 15 years. So the inside basis of the partnership assets that you acquired by purchasing some others partner's interest, you get a step up to what you actually paid for those assets. Therefore, your inside basis matches your outside basis. Because otherwise, you're being cheated out of a depreciation deduction. I got a beat up desk that's 10 years old. You know, it's already fully depreciated. So, and you paid $100,000 for this asset, and you got nothing to write off. So that's a hardship when you've actually acquired an asset. So that's what the 754 election does. It's a way to adjust the basis to reflect what you actually paid
Instead of what
for
the
your
asset
partnership
was.
interest. Now, those assets are stepped up only with regard to you as a partner. The basis of those assets for the other partners remains what it was. It's just an adjustment inside the partnership
Only the
as it
new
relates to that partner who
partner is
purchased the
step up.
interest. So let me read you the sentence again, and you tell me whether you think it's true or false. A Section 754 election is usually made by a partner who purchases his partnership interest from another partner, and the assets of the partnership have appreciated in value since the time the selling partner acquired his partnership
False.
interest.
The keyword is have appreciated in value.
Well, obviously, if you're paying more for it, some asset in the partnership must have appreciated that. It might not have been the desk, but you're buying goodwill. So that is a true statement. It's a true statement. That's the reason why you make a 754 election.
I thought it was if the asset has appreciated, you want
Appreciate.
appreciated.
Appreciate.
Do you do bonus or section 179 on assets on?
I don't think so. Because it's still an asset of the partnership. It's not a new acquisition. In order to take section 179, it has to be a new acquisition.
And bonus.
I know what you're saying, it's a new acquisition in the partner's eyes. I mean, he just bought something, but it's still an asset of the partnership. It's not his personal asset.
Yeah.
All right, next. I used a car for personal purposes. Drove it around, had fun, took the girlfriend out, all that kind of fun stuff. Then I decided, hey, I need to make some money, so I wanted to join this partnership. And the only asset I had to contribute was this personal car. Let's say it was a Lamborghini. I paid $100 grand for it 2 years ago. Now it's probably only worth 60 because I beat the shit out of it. Okay? We're gonna use the car for business in the partnership. We're gonna entertain clients, and dine and everything. I think that we're full of basis are you going to use for depreciation purposes? What I paid for the asset 2 years ago, $100,000, or what it's worth now?
Fair market value.
You are correct, sir, actually I should say, I should try to beat you. Isn't the general rule?
No, of course not.
Isn't the general rule is that the basis to the partnership is the same as my basis? Isn't that the general rule? Sure it is.
Okay.
The question is, what's different about this set of facts?
Because you use it for personal use and then for business.
Correct. That is exactly what it is. And that's the reason why you use fair market value. Does everybody understand that? If the asset was used for personal use purposes, and the asset is declined in value, you don't use your original cost. You use the lesser of your cost or fair market value. When you're converting a personal use asset to a business asset. So that's an exception to the rule that, you know, I am exchanging this car for my partnership interest. Okay? Normally, basis of my partnership interest will be the same as the basis of the asset I contributed. In this case, there's an exception because it was formerly a personal use asset. He's 100% correct. You use fair market value if it's less.
So that would be his basis in the partnership interest.
Right? And it's also the basis to the partnership for depreciating
It's the
purposes.
lesson.
Okay?
For depreciation purposes, but there was another scenario where so there's a basis for the depreciation purposes, and then there's the other basis for that the partnership has on the asset contributed, which is.
I think you might be thinking of when you acquire an asset by gift, and there's loss basis and gain basis. Is that what you're referring to? And generally, the basis for property acquired by gift is the donor's basis, unless at the time the gift is made, the fair market value is less than the adjusted
There was
basis.
a question similar you did that you asked us, what is the basis to the partnership for purposes of calculating depreciation, and what was the basis to the partnership for basis of calculating a gain or loss on the sale of the asset? So which one would you use?
Well, if it's a personal use asset, you're not taking any depreciation, so it'll be one and the same in this example. If it was an asset I previously depreciated, well, let's take the example that you want, okay? You tried to draw a distinction between these facts and the
Right,
previous
because
one,
yeah.
so let me make it clear. The facts of the problem I posed to this gentleman, it was a personal use asset. There's a special rule for that situation. It's lesser of cost, basis, or fair market value at date of contribution, because it was formerly a personal use asset. If it was not a personal use asset before, let's say I used an asset in my sole proprietorship before I contributed to the partnership, that's a totally different set of facts, okay? Then it's just carryover basis. So if I had this car in my sole proprietorship business and I was using it for business, and my original cost was 20, and I took depreciation of 4, my basis would be 16. My partnership interest I get back for contributing the car would be 16. The partnership's basis in the asset would also be 16. 20,000 for depreciation purposes, but you would have to record the 4,000 depreciation I took when I was sole proprietor. So the way you would book that asset on the books of the partnership, you would, debit car 20,000, debit a credit accumulated depreciation 4, credit my equity 16.
Yeah, I
So
think that's
it's
exactly.
strictly a carryover basis. So what you're drawing several distinctions here, which is good. First of all, if it's a personal use asset, the carryover basis rule doesn't apply. There's a special exception.
Okay.
That's number one. Number two, in the case where it was not a personal use asset, it's carryover basis. The partnership starts depreciating the asset in the year on my depreciation schedule as a sole proprietorship. So if I depreciated for 1 year and then contributed to the partnership would start in year 2 of the depreciation schedule. You would book it at 20,000 with accumulated depreciation of 4. Even though I, as a sole proprietorship, took that 4,000 depreciation. You understand what I'm saying? So that's a separate set of facts. What I was asking him is, what happens when you contribute a personal use asset? There's a special rule. Yes?
I'm gonna be jumping the gun, but let's say you have a home that you live in and then turn it into a rental. That's the example where. if
That's
your
another
home-
example,
right,
the
if your
same
home
thing.
appreciates,
In fact, I had that situation. What you usually do then is you try to get appraisals. Like if the property's declined in value, you find an appraiser who'll appraise it at what you paid for the property, so you don't have to take the lower of the two. I inherited my mom's, property. It's funny you should raise that issue, because I inherited my mom's property in 2007, at the height of the mortgage debacle. And the property, when I placed it in service, the fair market value of the property was less than the fair market value at date of death. So the question is, which basis should I use? And it's supposed to be the lower of fair market value or your regular adjusted basis. And I had to have appraisals made according to instruction, so I could get the basis that I wanted. So that is the problem. It doesn't matter whether it's a car or a residence. If it's a residence, it's a personal use asset. If you contribute it to a partnership, your basis, the partnership's basis for depreciation purposes and your basis for your partnership interest will be the lower of your original cost or fair market value at date of contribution. That's only for personal use assets contributed to the partnership. A special rule. Go ahead, we need to move on. All right. I got a real easy question. All right. Simple facts. You and I are 50-50 partners. The partnership makes 40 grand for the year, and you receive a $5,000 distribution of those profits. What's your distributive share? We repeat the facts. For 50-50 partners,
I'm sorry, 2,500.
50, well, let me repeat the facts again. I think you didn't get all the facts. For 50-50 partners, the partnership earned $40,000 and it distributed a $5,000 distribution to you. What is your distributive share? Listen to my question. What is your distributive share? Nothing else. This is a typical exam question where it's really, really simple, but we throw in red herrings to screw you up.
That would be 20.
Yeah, that's it. That's it. Is the $5,000 distribution of any friggin' relevance at all to the question I'm asking you? No. Same question as that I discussed with you previous out. Remember? Your distributive share has nothing to do with distributions. It's a pass-through entity. Okay? The taxable event is not the distribution. Everybody got that? All right, next. Okay. Here's a quick little math exercise on how to calculate basis. You contribute, make a capital contribution of 40. Okay, you're 50-50 partners, okay? You contribute capital 40. You have muni bond interest, which is tax exempt, of 8. Partnership does. You receive a distribution of 2. And you have investment advisory expense of 2.
The partnership has investment advisors.
Yeah, the partnership, the muni bonds are owned by the partnership. So the partnership earned $8,000, there's a distribution to you of 2, and the partnership paid $2,000 in investment advisory expenses. These expenses are non-deductible. This interest is tax exempt. No other transactions involved. What's this partner's outside basis? How would you calculate? Where did I leave off? The gentleman in the middle, writing furiously, trying to write down everything I said.
Most everything.
Yeah, I know. I remember that problem well when I was a student. You know, I probably would have gotten much better grades in college had I been a good note taker, but I sucked at taking notes, so I just couldn't write. Yes. What is this gentleman's basis of his partnership interest? He contributed $40,000 in capital to start. The partnership earned $8,000 in municipal bond interest, which was tax exempt. A $2,000 distribution was made to this gentleman, and the partnership incurred $2,000 in investment advisory expense.
38,
Well, tell me how you did it.
$40,000, initial capital contribution.
Okay.
Okay, the distribution, to him, the partner, reduces his basis, yep.
Correct.
The, advisory expenses. Those aren't deductible.
Does that matter? I'm asking
This
you
is
to
outside-
calculate basis, outside basis in his partnership interest.
No.
So what do I do with it?
Disregard it.
What? What about the muni bond interest? What are you gonna do with that? Anything?
No, I'm sorry, that's 8, I'm sorry. 4,000.
4,000, thank you. Why? Because it's 50%, he's a 50% partner. This is what the partnership incurred. Same thing with this. Okay, finish it. Quickly, gotta get through this.
Okay, and 1,000.
$41. The fact that those items, that the investment advisory expenses and the municipal bond interest were tax exempt has no bearing on basis. Municipal bond interest is income and increases your basis and your partnership interest, just like any other kind of income would. The fact that it's tax exempt is just gravy on the mashed potatoes that we can all rejoice about. Okay? Next. All right. You're next. When a partner's distributed share of losses exceeds his outside basis in his partnership interest, the entire loss in excess of basis is permanently lost. True or false? And explain your answer.
False.
Correct.
You have to increase the,
What is incorrect about that statement?
that is permanently lost.
Correct. It's not permanently lost. What happens to that loss?
Goes in the purgatory.
Yeah, it's in Catholic heaven, hell, tax purgatory until Ray Skelton, the great tax planning Jesus of all time, gives you advice and tells you to do what?
Reestablish your base.
Increase your base.
And how might I do that?
Capital contribution,
Capital contribution,
income.
make money next year, take out debt in the partnership name, yada, 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 yada. So it's not permanently lost. There's a way to free those losses from tax loss purgatory. Okay? Let me do one more. This is an easy one. When computing a partnership's ordinary taxable income, a deduction is allowed for net operating loss carryforwards. True or false? When computing a partnership's ordinary taxable income, a deduction is allowed for net operating loss carryforwards. We talked about this before. Can a partnership ever have an NOL?
No.
False. Why can a partnership never have an NOL?
It's a pass-through entity.
It's a pass-through entity. I'll keep repeating it until you guys get it. Okay. Next. All right, this one I need to write down the words. Since you're on this side, I'm gonna have to do it over here. All right,
It's half of this.
Oh, I mean,
let's make this one quick.
I mean, that's the information.
Let's
that-
say
Municipal bond.
Let's say you're a 50-50 partner,
No, this is the cash.
Contribution.
and you contribute 20 grand each as capital contribution. Okay? Partner A contributes cash. Your partner B, you contribute property. whose fair market value is 20, but your basis is only 2. Got the facts?
Alright.
The partnership incurs a loss in its first year of $10,000. How much is each partner able to deduct of that loss? Let's start with partner A. Well, first of all, they're 50-50 partners. So each partner is entitled to how much?
So the max of 5,000.
A max of 5,000. 5,000 each partner. Can A deduct his 5,000 loss?
Yes.
What about B?
That you would have this amount on.
I'll ask the question again. How much can B deduct?
Oh, I'm sorry, that's good.
2. Is that what you said?
Yeah.
You are correct, sir. Why can't he deduct 5?
That's what it is. Yeah.
Because his basis is only 2. What happens to the remaining 3?
This amount.
Tax season purgatory. Okay, I'll lead you all the way in the back. Finally, make my way back to you. Let's start with the easy one. Guaranteed payments to partners we're talking about. So the partnership pays one of the partners a sum, either for performing services for the partnership or for lending capital. They're tax deductible to the partnership. True or false? Guaranteed payments to a partner are ordinary income to the recipient. Was the partner receiving the guaranteed payment? Do they have income? Yes. Okay. All right. So the partnership gets a deduction. The partner receiving it has to pick up income. Simple enough. How does the partnership always get a tax deduction for a payment, a guaranteed payment to a partner? Or are there certain instances where a partnership might have to capitalize the payment to be guaranteed payment? Yeah. Let's say, like in the example I gave with this young lady in the center here, the services you provide is you're a construction contractor and you're building a building to go. The payment represents payments for your services in doing and constructing the partnership property. You'll still pick it up as income, as a fee. But what does the partnership have to do? Can they just deduct that, or would they have to capitalize? They would have to capitalize it, because why? Part of the cost of the building. So do not assume that just because it's a guaranteed payment, and this is good because I kind of stress the fact that it's always netted in that line under there. There is times when the partnership cannot deduct the guaranteed payment. if it's a capitalizable expenditure, just like if it's any other kind of capitalized. Last question, this is the toughest. You're a partner, you're performing services for your partnership that you co-own with the other partners. Are you ever considered an employee of the partnership? No, never, nada, ever. You will never see a W-2 to a partner unless the bookkeeper didn't know what they were doing. That happens. Right?
It happens a lot.
Yeah, I mean, it's common practice for the bookkeeper, you know, the partner, just because he's the owner, I mean, he's just like an employee like anybody else, he's just like he would be for an S corp, or if you're performing services for the company that you work for, the fact that you're an owner shouldn't make any difference. Well, in partnerships, it does. You're never considered an employee of a partnership in which you are a partner. That's not the way they work. Partners either take draws, distributions, or they take guaranteed payments.
Is there any percentage of interest limitation? I mean, if I'm 1% owner of a partner.
No.
No?
No. Okay. All right.
And how do you do lawyers that I've seen a ton of you guys that have salaries, and maybe there's a partner that only has 1%?
Just because it's done outside in the real world doesn't mean that they're doing it correctly. I bet you there's a zillion partnerships just through under oversight that they just want to set them up with a pair so the partner gets a check every week just like everybody else does. They run it through their ADP or whatever employee service they're using, and they're getting a W-2. And they're taking out Social Security taxes and everything else. Here's the interesting thing though. Guaranteed payments to a partner are subject to self-employment tax. So unlike an employee, the partner pays the entire Social Security tax burden. It's not shared half by the partnership and half by the worker. So
I
there is
mean,
a difference.
anyways, the partnership is paying for the self-employment tax.
Yeah,
It's actually paying
it perhaps distinction without a distinction, but for purposes of filling out tax forms, you should be issuing a W-2 to a partner in the partnership. Okay. Now, let's go back to the outlines a little bit. Now we're going to start getting back into some of the stuff that we discussed 3 weeks ago. Okay, let's lecture a little bit on this. Remember we talked about that the partnership initial accounting year, there are certain decisions that the partnership has to make. One is the method of accounting you're going to use, cash accrual or some form of hybrid. And the other is what tax accounting year you're going to use. Also, your elections of what you're going to capitalize or expense, methods of accounting, methods of depreciation, etc. Now, there's going to be a question on your exam that you need to know. Where are those decisions made? By the partner or at the partnership level? Partnership level. Okay. The only exception was that bizarre thing we were talking about earlier about separately stated items for the foreign tax credit where the partner has to make the choice. With the exception of that one item, all those elections and choices are made by the partnership, by the managing tax matters partner. In fact, you have to disclose on the tax return who the tax matters partner is. Let's say you have 10 partners, one of those partners has to be the taxpayer's partner who is responsible for making these tax decisions. Now, it's not like you're free to do anything you want, as we're going to see. I want to draw your attention to these PowerPoints 2 and 3 on this slide here. Especially the young lady in the middle back there, because your next question I'm going to ask you is about this subject. And it deals with adoption of the accounting year by the partnership. There are severe limitations on the choices you can make. And it's pretty complicated. There's a 3-tier approach. The first rule says that if any partner owns or partners own more than 50% in interest and profits and capital, the partnership has to use the accounting year of those partners. Okay? So if you've got a major partner who owns a big chunk, or a couple of partners that own more than 50%, and they're both all using, March 31st as their year end, because they're corporations or something, then the partnership has to have a fiscal year end. Okay? If that's not applicable, notice it says, if A is not applicable, that's the first rule. You must adopt the year end of partners owning 50% or more in profits or capital. If that's not applicable, you adopt the same tax year used by all principal partners, 5% or more. So if you got enough of 5% more partners and they're using a particular method, then you use that if nobody's using more than 50%. If that's not applicable because of your facts, then the third tier is you adopt the year that results in the least aggregate deferral. You guys remember what those 3 magic words mean? In other words, generally speaking, you're not going to choose January 31st as your year end, because that's gives you the most aggregate deferral till 11 months, right? So you apply these rules in a tier, and 1 by 2 by 3. If A is not applicable, you go to B. If B is not applicable, you go to C. Now, having explained that, I'm going to give you the facts of the next question. We've got a partnership. It's owned there's 3 partners. There's a corporation and 2 individuals. The 2 individuals own 20% of the partnership interest each, which means the corporation owns how much? Okay? The corporation has a July 31st year end. The individuals have a calendar year, like most. In 40 years of practice, I have not seen an individual on the accrual basis of accounting or on a fiscal year. It's always been capped. It's very rare to see that. Now, I'm going to give you some other facts to muddy up the waters a little bit more. You have to decide whether these are red herring facts or whether they have some relevance in determining. The whole question deals with what's the year end going to be, okay? That's what I'm leading up to. But before you, the question is difficult without going through the rules. The gross receipts have averaged $100,000 for the last 3 years. gross receipts during July and August. Were about $20,000 for each month. The partnership business is not really seasonal. Not seasonal. Although it is busier in certain months than others. The partnership is considering requesting permission from the IRS to use an August 31st year end, because they believe that's their natural business year. Based upon those facts, what year end, first of all, can the partnership use any tax year it chooses? Answer that one first. That's the easy one. No. They gotta abide by these rules. Is there any year end that they are required to use based upon the facts as I've given them?
Well, yeah, number 8, like the
There we go.
percent.
All right. Explain that in a loud voice to everyone, quickly.
Well, the number 1 through 8, which is cost of year of foreign owing 50% or more, profit capital,
Yeah, it's a C corporation owns 60% of these facts. Therefore, that's it. You're in tier 1, you stop right there. No point in asking for IRS permission for anything. You're not even in the gray area. So therefore you would use July 31st as a year end, okay? Now, if we were to change the facts a little bit, let's say the corporation only owns 40% of the partnership and the other 2 partners own 30%. Then, let's see, well, if A and B, A is not applicable, adopt the tax year by all principal partners. Well, you have 2 individuals that own 30% each. Then you would have to use their year end, which would be December 31st. Okay. Now let's mutter out the waters some a little bit more. Let's say we have 39 other partners that own 1-2% apiece, which is basically the corporation owns 40%, all the other partners own maybe just 1%. Then you'd have to adopt the tax year resulting in the least aggregate deferral, unless, let's read the rest of the slide. If a partnership wants a different tax year allowed other than what A, B, and C, those 3 tiers are, you have 2 choices. You can ask IRS permission to use a natural business year. Well, in order to do that, you're gonna prove you're seasonal. Like you're a ski lodge or something. Yeah, the facts that I gave you say, well, that won't work. And then last but not least, I probably won't ask you this on the exam, but you just need to know it's there. The last thing you have is this 444 election. Now, the 444 election only allows you to defer how long?
3 months.
3 months, okay? Very good. All right, let's move on. Now we're shifting gears completely. We were talking about accounting years. Now we're talking about methods of accounting. Is it possible for the partnership to use one method of accounting while one of the other partners uses another method of accounting? Really, you think there's some kind of similar restriction, like if the partners do one thing, then the partnership has to do the same thing? That's the way it is for accounting periods. But is there a singular rule for accounting methods? In other words, let's give you an example. I'm an individual partner. I'm gonna be on the cash basis account, more likely than not. But the partnership is in the business of selling widgets, inventory.
It can be.
So what method of accounting does the partnership have to be on? Accrual. Yeah, why?
Because of the type of,
Inventory is a material income producing factor, you gotta use accrual. So there's a perfect example where the partner is on one method of accounting, the partnership is on another method of accounting. So they don't necessarily have to be the same. Don't confuse accounting periods with accounting methods. The rules for accounting periods are much more restrictive, because they're worried about the deferral issue, okay? Think about it this way. Maybe you've even prepared, have you prepared individual tax returns? Have you ever prepared a tax return where a 1040, where the sole proprietorship sells inventory? So the Schedule C is on the accrual basis. But for everything else, collecting dividends and interest and rents and salaries from his wage job, he's on the cash basis. So don't think that there's something nefarious or unlawful about the same taxpayer having multiple methods of accounting. It's done by income source, okay? And so it is with partnerships. So here's the question. A and B are equal partners in a partnership which earns virtually all of its income from the sale of inventory. True or false? Either partner may use the cash method of accounting.
are the partners?
Yeah. So, that's true. True or false? The partnership must use the accrual method of accounting. The partnership must use the accrual method of accounting. You say that's true. The partnership may only use the accrual method of accounting if both Allen and Baker use, A and B use the accrual method of accounting.
Can you repeat again?
The partnership may only use the accrual method of accounting if both partners use the accrual method of accounting. False. In fact, partnership has no choice. It's going to use accrual based upon the nature of business that they're in. And that's true. It's not just inventory that will choose your accounting method. Let's say you're in the construction industry. You might have to use the completed contract method or the percentage of completion method. Okay? So, it's those kinds of things that dictate your method of accounting, not what the partners do or don't do. What the partners do or don't do is important only for choosing accounting periods. You guys did great. All right. You guys are all doing good for class participation. It's good. We'll keep you all awake. All right. Here's the next question. Lady in the back there. Continuing on, back to accounting periods again. So remember everything we just discussed with this lady here, the 3 different tiers approach. We've got 3 partners in this partnership. A has a January 31st year end, partner A. Partner B has a September 30th year end. Partner C has a calendar year end. They're all equal partners. They all own a third, and a third. Assuming we're not going to go for asking the IRS for permission to use a natural business year, how are you going to choose your year end? This is a difficult question. So here's what you need to do. Does tier A apply? Does any partner own at least 50%? Alright, so we go to B. If A is not applicable, adopt the taxable year used by all principal partners. Can you use that one? Is there any partner that uses, more than one partner that uses the same year? No, let me repeat the facts again. A has January 31st, fiscal year end. B is September 30th. C is December 31st. So B doesn't help us out either, does it? So now we go to C. If A and B are not applicable, it must adopt the year resulting in the least aggregate deferral. So that's what you would do. Which would be what? December 31st. No deferral at all.
But if it's December 31st, the one that ends up in January is going to be for 11 months for tax purposes. So it has
Well,
to be
January
that year.
31st offers the most deferral.
Yeah. So it has to be most kind of.
The closer you are to December 31st results in the least aggregate deferral. And also depends upon the number of partners. I mean, if you got 5 partners in February and 2 partners in March, and then it really gets to be calculating the least aggregate deferral can get very, very complicated. If you've got hundreds of partners, all with all different kinds of year ends and different ownership percentages. So the answer is you would, in this particular case, you would use what? What's the magic phrase? Least aggregate deferral. Which would be what under these specs? Which partner has the least aggregate deferral? C. December 30th, which is no deferral at all. Okay? All right. All right, we're back over here now. No, she skipped that on us. So you're gonna get her tough question. Partnership terminations. Let's see if I can find that one quick. Okay. Here's a slide that's going to help you out. The issue is, when is a partnership terminated? In determining when the tax year for both the partners and the partnership, in determining when the tax year ends for both the partners and the partnership, there's 2 considerations here. When does the year end for the partners? When does the year end for the partnership? They may not be the same. Okay? Knowing when and if a partnership has terminated for tax purposes becomes extremely important. The taxable year of a partnership does not close prior to its normal year end unless there has been a termination. The term termination is a concept strictly involving the Internal Revenue Code. Do not, I repeat, do not confuse it with dissolution of a partnership under state law, under RUPA. Okay? It's strictly a tax law concept. When a termination has occurred, the taxable year of the partnership, as well as all the partners, closes at the date of termination. Memorize that. That's 708A, word for word. So, once you've determined that the test for a termination has occurred, you already know the end result. The tax year for the partnership closes as of that date of termination. And so does the tax year for the partners, not with respect to their non-partnership activities, but with respect to their partnership activities. The partners' year ends on the termination also. Okay? The tax law term termination has nothing to do with and must be distinguished from dissolution or liquidation under rule. Okay, so when does a termination occur? Here are the three events. 1, 2, 3. So you need to know those rules if you can answer a few questions on your test. Let me give you some facts. Oh, actually, there is some facts. Based upon what I've determined, what I've told you so far, answer these true false questions. The termination of a partnership for tax purposes is not governed by the rules of dissolution or liquidation of a partnership under state and local law. True. A partnership's tax year closes on the date the partnership is deemed terminated. True. Okay. This one, you're gonna have to use a little common sense. Any partnership is considered terminated on the date when it no longer has at least 2 partners. True. Now, it's interesting, 708A doesn't specifically say that. It's just kind of understood. It takes 2 to tango. You can't be partners by yourself. Okay? Now, the piece de resistance, the toughest part of this. If any partner withdraws from the partnership while the business of the partnership continues to be carried on by the remaining partners, the partnership is deemed terminated for tax purposes, and the partnership must close its taxable year on the date of the partner's withdrawal. False. Very good. Now, under those facts, the partnership year end will terminate for that partner, but not for the partnership. Now, let's read these rules. Unless there has been, within 12 months, a sale or exchange of 50% or more of partnership interest in capital and profits. So, if more than 50% of the partners have turned over, that's enough. So, if more than 50% of the partners leave the partnership, that terminates the partnership for the partnership. Okay? So, a termination occurs only if no part of any business is being carried on by any of the partners. Now, let me explain what that means. Let's say you and I are in a partnership together. And we're in 2 businesses. We make hats and we make dresses. And we're not making any money selling hats to guys. Guys don't wear hats anymore. So we just terminate that business. We continue to carry on the dressmaking business. Are we still in partnership together? Even though we closed one of the business? Well, that's what that says. No part of any business is being carried on. In other words, you have to be doing nothing. Or there ceases to be at least 2 partners, or there's been a sale or exchange of partnership interests of 50% or more. Now, determining whether there's been a sale or exchange of 50% or more partnership interests, gifts of partnership interests are non-exchanges for that purpose. So if you give your 50% of your partnership interest to your daughter, that is not considered a sale or exchange for that 50%. Finally, the last idea on this, if a partner disposes of their entire interest in the partnership, either by sale, death, liquidation, or otherwise, without triggering a termination of the partnership as applied above, in other words, you partnership who left owed less than 50%, and only that partner left, the partnership tax year closes only with respect to that exiting partner or partners. The partnership continues to its normal year end with respect to the remaining partners. And that's partnership. A partnership termination beaten to death. Based upon that, similar concept. True or false? The death of a partner closes the tax year of the partnership for all partners. True or false? False. Why? It doesn't terminate the partnership. Does it terminate the tax year for that partner? Yes, but not for the partnership. No, unless that dying partner owed more than 50% of the partnership. Okay? True or false? The complete withdrawal of a partner from a partnership closes the tax year of the withdrawing partner. True. You see the distinction. There's a determination of termination for the partner and for the partnership. Two separate considerations. True or false? The tax year closes for all partners on the date when no part of any business or financial operation continues to be carried on. True. There's three things there, all right? All right, let's move on. How much time have I got? Holy crap, I'm not even gonna begin to even start the, I guess I'm gonna have to put fewer questions on your final, so we're not gonna get as far. Here are the facts. I operated a sole proprietorship, and I contributed an asset.
Alexa.
Somebody's talking back.
Serious stuff.
Did I do that?
No. You're so weird.
It's hilarious. Alright, so I had a sole proprietorship. I had a depreciable asset I was using in the sole proprietorship, and I contributing that depreciable asset to the partnership. I acquired the property for $10,000 5 years ago. Believe it or not, this machine has gone up in value. Now it's worth $15,000 the date I contributed. And I only depreciated it for 1 year before I contributed to the partnership. And I'm using the straight line method of depreciation with a 5-year life. Question 1. What is the partnership's basis in that asset for calculating depreciation? You have two choices. I bought it for $10,000 a year ago. It's worth $15,000 on the day I contributed. $10,000. The partnership simply steps into the shoes of the sole proprietor who contributed the asset.
But what about the depreciation of the 2,000?
Same thing, that's the next question.
Okay.
I like it, you're thinking ahead.
Cause I was gonna say 8.
Okay. In fact, okay, let me give you some more facts so I can illustrate what I'm talking about. I purchased the equipment for $20,000. I took $4,000 of depreciation in year 1, 5-year life, straight line, okay? What is my basis for calculating your partnership interest? 16. What is the partnership's basis for calculating depreciation? You step into the shoes.
Back to the
20.
20?
20.
Okay.
Now you'll book, on the partnership's books, you'll book machine 20, accumulated depreciation, credit for 4, and credit my partner's capital account for 16.
Mm-hmm.
Okay? You just continue on.
You just carry
Yeah,
it forward.
you kind of step into the same shoes as the sole proprietor, and you use the same depreciation schedule the sole proprietor was using, which is kind of weird. Usually when you put it into a new entity, you start from year 1, but you don't in this case. Okay? What method of depreciation must the partnership use?
Still straight line?
Yeah, same as that I used. What about the useful life?
Straight
Same thing.
line.
So, the basis for calculating partnership interest is 16.
Mm-hmm.
The basis for calculating depreciation is 20, but you book the 4,000 depreciation, and you use the same
Straight line method.
depreciation and same recovery period as the sole proprietor used. Okay? Now, the toughest question. True or false? The partnership may make a Section 179 election on that equipment that I contributed as a new acquisition. True or
True.
false?
False.
You know the answer because we
Yeah.
answered the spirit. Go ahead.
I said true, but
That's like false because it's not new.
Yeah, it's not considered a new acquisition. It was a new acquisition when I bought it as a sole proprietor. Whenever it's just a transfer or carryover basis, that's not a new acquisition. You're not gonna get a Section 179 deduction in a 1231 exchange. You're not gonna get a Section 179 deduction on any carryover transaction. It doesn't meet the definition of new,
new.
okay? So just remember that. Okay. Next.
Just answer. Just answer.
You'll like this one. Okay, here we got, I've been a busy little lawyer working for your partnership. And I incurred, my normal fee, legal fees for doing these things. I charge you a ton of money to draft a partnership agreement. And then in addition to that, I'm also a broker, so I'm incurring professional fees and commissions and printing costs to market and issue the partnership interest. This is a publicly traded partnership. So you're paying me a chunk of money to market and print and issue these partnership interests. Then you're paying me another chunk of money to draft a partnership agreement. And since what this partnership is going to be doing is we're going to be leasing office space to tenants, so I'm drafting a model lease. So let's say I'm charging you 10 grand to draft the leases, 60 grand for the commissions to sell the partnership interests, and another 15 grand for drafting the partnership agreement among the partners. How would you treat each one of those separate legal fees? The question is, number one, is it immediately tax deductible as a trade or business expense? Number two, is it capitalizable? And number three, if it is capitalizable, can it be amortized as an organizational cost or startup expenditure? Let's start with the legal fee to draft a partnership agreement. What kind of cost would that be characterized as?
You can, for that, you can do up to 5,000, you can expense it, it's deductible.
Well, first of all, characterize it first.
Characterize it?
Yes. And then what, so this rule that you're espousing.
Right, so it's either organizational or it's an organizational cost.
Right, so it's that code section 248 cost.
Okay.
It's not a startup expenditure, because
No.
drafting a partnership agreement is considered
So
organizational.
it's an organizational cost for which you can, get a $5,000 deduction, and you can, capitalize the rest,
Okay,
which will be.
and the part that you have to
10,000
capitalize, can you amortize it?
over the next 15 years.
Okay, and amortize means what?
Take a depreciation for it.
Well, it means what method are you using?
Straight line.
Yeah, amortization, remember this, write this down in your notes and just remember it. Amortization is always,
Straight line.
and
Okay.
it's 15-year life, specified by code section 248.
Okay, so that's that.
What about the attorney's fees to draft the tenant leases?
That one is it's completely deductible.
Yeah, it's a trade or business expense. If you've been incurring that cost before you actually prepared the property for leasing, then it would be a startup cost.
But then you wouldn't be preparing the leasing because you don't have any tenants. So
Well,
it's
if
good.
you're drafting a model lease that you're gonna negotiate.
Oh.
But generally speaking, you're right. Usually you incur those expenses when you got a tenant sit in front of you and you're trying to get a signature on the document. Once that starts, then you're already operating as a lessor, and it'll be a trade or business expense. Very good. Last but not least, the professional fees and commissions and printing costs to market and issue the partnership interests. How do you categorize this? So this is important. Give me your categorization first.
I think, I don't know if I'm wrong, I may be wrong, but I have a feeling it's a syndicate cost. It's a syndicate cost. Am I saying that right?
Syndicate.
Yeah, syndicate.
Let's refer to.
Who has code section 709 in front of them?
Right here.
Okay? Why don't you read it aloud, read the general rule.
General rule, except as provided in subsection B, no deduction shall be allowed under this chapter to the partnership or to any partner for any amounts paid or incurred to organize a partnership or to promote the sale of or to sell an interest in such partnership.
Now, what's interesting about that sentence is part of the sentence seems to be referring to organizational costs, which is a separate code section 248 that allows you to amortize them and deduct them up to $5,000. But then there's this, read it again, especially the last part of the sentence.
Last part of which sentence A or B, or just go over it again?
The last part, just the last, parenthetical phrase of 709A. Paid or incurred,
Paid or incurred to organize a partnership.
stop, well, that sounds like organizational costs right there. And then it says what?
Or to promote the sale of or to sell an interest in such partnership.
Now, that last phrase, those items are not included in 248. Paid or incurred to organize a partnership or to promote the sale or to sell an interest in such partnership. That's what we're talking about here. And those are syndication costs. That's the word, syndication. So you were right, syndicate, it's close to me. Now, based upon that sentence, if syndication costs are not organizational,
Then they're not.
then 709 governs that. What does that tell you?
Then they cannot be.
Capitalized but don't have
Yeah. In other words, your SOL, shit out of luck. You don't get, it's gonna just sit there like a useless clump of intangible asset for as long as possible, or until the business goes out of business or the business itself becomes worthless. It's just gonna sit there, a great big disgusting non-deductible expenditure on the balance sheet, which, as you can tell, just goes against the grain of every tax lawyer on the face of the earth. So you have three different levels of things going on here. You have some expenditures that are fully tax deductible. You have some that are partially tax deductible up to $5,000, and then you amortize the rest over 15 years. And then you have others, the syndication costs, that are not amortizable or deductible. Okay? So there's your universe. How much time do I have left? I have no time. I suggest we go for a few minutes longer. All right, okay. A section 444 election permits a partnership to adopt a fiscal year so long as the deferral is no greater than 3 months, and the partnership is required to pay an advance deposit of income tax being deferred by the partners. True or false? So there's two parts of it. Deferral of no greater than 3 months,
That's true.
and you gotta pay a deposit. If you're gonna make this election, you gotta pay taxes up front.
That's true too.
And you say those are both true. You are correct. Okay. That's a section 444 election, in a nutshell. Here's an easy one for you. Generally, a partnership pays no entity level income tax. True or false? True. I'm gonna come back to you in a second. I have a question for you. Most elections affecting the computation of income derived from a partnership are made by the partners. True? Most elections affecting the computation of income derived from a partnership are made by the partners. Is it the partners or the partnership? What's the answer then? It's partnership. They're always made at the partnership level. Okay. True or false? Now we're talking about a different subject. The next subject is, how do we distinguish transactions between a partner and the partnership where the partner is dealing with the partnership in his relationship as a partner, and other situations where the partner is not acting in his capacity as a partner. For example, when I was giving her that list of all these legal fees that I did for the partnership, I was performing those legal services as an outside consultant, as a lawyer, okay? So how we look at the transaction, is it an inside deal between the partner and the partnership? Or is it like dealing with independent parties? Is it a related party transaction? Or is it like dealing with an outside stranger? The question is, it could be either or, depending upon the facts and circumstances. So, true or false? The Internal Revenue Code generally adopts the entity approach to transactions, between a partner and the partnership when the partner is not acting in the capacity of a partner. Think about that. Let me read it to you again. The Internal Revenue Code generally adopts the entity approach to transactions between the partner and the partnership when the partner is not acting in his capacity as a partner.
True.
Explain why you think that is so.
Pathological, the approach means that you would treat separately.
Right? So if you're not acting in your capacity as a partner, you're just like any other stranger that the partnership comes in contact with, or any other vendor, or any other lawyer, or whatever, whoever the relationship is. A lender, a creditor. Likewise, let me give you the perfect example. If the partnership signs a promissory note, you're gonna lend money to the partnership, not make a capital contribution. And you wanna document it, you wanna be paid an interest rate, default provisions in there, all the protections, and you might even have a collateral attached to a partnership property. Is that transaction in your capacity as a partner? Absolutely not. It's strictly a debtor-creditor relationship. The fact that he also happens to be a partner is kind of incidental. Now, that particular factual scenario is easy to distinguish between a partner and someone who's not acting in his capacity as a partner. A lot of times it ain't so easy. That's where it becomes a facts and circumstances mess of an analysis. So now we're getting into that issue. True or false? Whether a partner is acting in his or her capacity as a partner or as an unrelated party with regard to a particular transaction may be a difficult determination and depends on all the facts and circumstances. Actually, that's not that hard a question. True. Facts and circumstances mess. True or false? Guaranteed payments are treated within limitations as if made to a non-partner. Are guaranteed payments basically treated as though he's really not a partner?
Well, actually, yeah.
Now again, if he's, why are guaranteed payments made? Usually it's two reasons. One, usually the partner is performing services to the partnership that the other partners are not doing. The other partners are just giving their capital and sitting on their ass. Whereas the working partner is, working 12 hours a day, and there's working partners and there's capital partners. So the capital partners, they may get a guaranteed payment for the use of their capital. The partner providing services is doing work for which he should be paid as though he was an employee. But as we know, partners are never employees, so it's a guaranteed payment. So both in those situations, we're looking at the relationship not as partners, but as the services or the capital that they're providing, okay? Now,
Right? The last one.
Guaranteed payments are treated within limitations that made to a non-partner, that's true. That is true. Any questions on that? All right, now. Last question, now I'll stop thinking. There are other situations. It appears more like a related party. Let me give you some facts. P, the partner, owns 60% of the capital and profits of this partnership. P sells an asset to the partnership for $10,000 when his basis is 20. Can B deduct his $10,000 loss? There's several facts in there that are really important.
Repeat that? Can you repeat that? Can you repeat the question?
You're a partner, you own 60% of a partnership. You sell an asset to the partnership at half of what you paid for. Can you deduct your loss?
Would it be the distributed share of the loss?
Again, it's just a transaction on the personal side. It has nothing to do with the partnership. The question is, I'm selling an asset rather than contributing it, and I'm selling it for less than what I paid for it, so I can write off a loss on my personal tax return. Can I take that loss? You say no. What authority do you use to support your position?
If I don't have an authority, but I just know the IRS doesn't like when you say losses.
Well, to say that the IRS never allows a loss is a bit
I
over the
didn't say
top.
never, they just don't like it.
What is the key fact in the factual hypothetical I just gave?
They're related, so you can't do it, right?
Related parties. The fact that he owns, I think it's over
It's 60%.
50%.
Right.
How many of you remember code section 267? Guys remember 267 at all from individual tax?
Oh, that's the one that tells you which ones are related parties.
Yeah. If you're my brother and I want to generate losses and I sell you a bunch of stuff for like 1/10 of what I paid for, so I can write it off on my taxes, people will be doing that all day long, right? That way I keep the asset within the family and still have control over it, but I'm taking all these paper losses on my tax return. The IRS doesn't allow that. It's a related party loss rule. Okay? Now, in code section 267, they have very complicated rules as to what constitutes a related party. Brothers, sisters, and lineal descendants. If you own a corporation, you own more than 50% of the stock of the corporation, all that kind of stuff. They call them the family attribution rules. They're horrendously complex. I'm not going to test you on the details of that, but you need to know they exist and be able to detect when a related party exists. And in this particular case, you've got a loss being taken by a partner who owns 60% of the partnership. Because he owns 60%, he can dictate what the financial policies of the partnership are. So it's like self-dealing.
Yeah.
It's not an arm's length transaction. Okay? All right. Okay, you're done. You're next. All right. We're gonna have to wrap this up. Going over. All right. Wow, I didn't think it was gonna take this long to get through all this. Okay.
halfway through it?
Oh, no. If I stop within 5 minutes, I've gotten to all but 5 of the questions. So,
Pretty good.
my students seem to, first of all, is this working for you as far as, this is a good review?
Yes.
Okay,
Wonderful.
okay. I just need to hear that out. Most of my students give me that reaction, so I wanna make sure that I'm connecting with you, because that's what this is all about. Otherwise, I'm just wasting my time. All right. Who knows a lot about, we didn't talk about this very much. Who knows a lot about special allocations? Who was the one who raised that issue? Okay, you did, okay. Back to you again. I love it. Did you-
I don't know
Because
why,
I
don't know if
forgot
that's
you
it.
didn't need to raise your hand, I would have not known the difference, but since you're a glutton for punishment. All right, as we've discussed, one of the unique attributes of partnerships is you can have special allocations, which are,
Like, basically going outside of pro rata through the
Right.
partnership agreement.
in other words, you can state in your partnership agreement, we'll share profits and losses 50-50, except for foreign tax credits, you get them all. Something like that. Now, those are referred to as special allocations, and they are permitted only in partnerships, but only if you meet certain requirements. Now, we're not gonna go in great detail. When I was in law school, my law professor went on for like 2 class periods of all the regulations dealing with when you can make a special allocation and when it'll be disallowed. It's a horrendously complex area. I just want you guys to understand the basics of it. Can you tell me what the 2 basic limitations on special allocations, what they are? There's a 3-letter term of art that's used. You know what those three words are? Does anybody know what they are?
Anyone else?
Dealing with special allocations. If your partnership agreement just drafts some bizarre thing that, you get all the losses, but I get all the profits, because I got losses deducted, you got, something really bizarre, just because your partnership agreement says that, does not mean the IRS has to honor it.
The economic substance doctrine?
Ooh, you're getting close. It's not a court-related doctrine, it's actually in the regulations, and it's a specific 3-word phrase.
Substantial economic effect?
Say that loud for everybody to hear, please.
Substantial economic effect.
Substantial economic effect. I could spend an entire semester going through the court cases that have tried to figure out what those 3 words mean, okay? There's the word substantial is the part that I'm not gonna get into. That's all in the regulations. The way that you figure out what the law is you read about 20 different examples in the regulations. This one is substantial, this one isn't. This one's, they can't define it in any particular way in the statute in any broad sense. But the term economic effect can be more specifically identified. Who can tell me, for 1,000 class participation and brownie points, what is economic effect? What do you have to do to prove that your special allocation has economic effect?
The partner's capital account needs to reflect the special allocation,
There we go.
and the liquidation proceeds must be distributed to the partners in accordance with the balances in their capital account.
Excellent. Let me repeat what she said and spin it out a little further.
Oh,
If
there's
you're
one more.
giving all the deductions to one person, but you're not charging them to his capital account, that's not economic effect.
And what's further, those capital accounts have to reflect your entitlement when the partnership is liquidated, the proceeds from it. So if you're getting all these allocations and deductions, but it's not affecting your capital account, or it doesn't affect the liquidation proceeds you will receive when the partnership is liquidated, then they have no economic effect. In other words, if I'm gonna allocate all these deductions to you, but we're not gonna reduce your capital account and thereby reduce the liquidation proceeds when we terminate the partnership, then they have no economic effect. In other words, the liquidation proceeds, the assets you're entitled to, when the assets are distributed to you, have to reflect these allocations that you've made. Otherwise, they do not have economic effect.
And there was other, I don't know if this is, okay, so when it says that if the partner has a deficit on their capital account, the partner is required to restore the deficit to the partnership. Is that in order for that allocation to occur? Or is that just a general rule for that?
Well, there's the substantial part, a substantial economic effect, which we're not gonna get into because it's way too complicated. Time we have, 5 minutes I have left to get through 5 more questions. You're not gonna be asked about that. But what I do want you to understand is a special allocation has to be reflected in the partner's capital account. And the partnership agreement must say that your liquidation proceeds of partnership assets should be in accordance with those capital accounts. In other words, your capital account, if your capital account ends up being negative, you're supposed to dig into your pocket and put it back into the partnership. A lot of times it doesn't happen. This guy takes all these deductions. Really, his partner should have gotten more proceeds, but because this deadbeat guy didn't make up his negative balance in his capital account, the other partners got screwed. That's what they mean by economic effect. Does everybody understand that? Okay? I remember when my law professor started talking about it, I had no idea what the hell he was. It wasn't until I started really teaching this course, right, I started to understand what he was talking about. It's the capital account balance. So yeah, it has to be, that's the difference between a law professor who doesn't know anything about explaining things in accountant's terms and someone like me who can. Bless you. Anyway. So, some more true-false questions for you. True or false? The special allocation provided for in the partnership agreement may be disregarded by the IRS if it does not have substantial economic effect. Absolutely. That's why we're discussing. True or false? Unlike S corporations, where all the distributive items of income deduction are allocated pro rata, based on the stock ownership percentage of the shareholder, partnerships may make disproportionate allocations of income and expense among the partners within certain limitations. That's what special allocation is. All right, that's enough about special allocations. All right. I think I'm just going to try to do these last 2 questions. I'm not going to be able to finish. Let's see what's left. Why not? Okay. True or false? Let's go down to this gentleman right here. Getting back to the distinction between a transaction which is in accordance with your capacity as a partner and one that is not. How to make that distinction? We didn't really talk about that much. This question gets to true or false. If a payment by a partnership to a partner is made without regard to the success or failure of the partnership venture, such facts indicate that the payment was made as though he was not a partner. Use common sense. Let me read it again. If a payment by a partnership to a partner is made without regard to the success or failure of the partnership, such facts indicate the payment was made as though he was a stranger and not a partner.
False.
Okay, he says false. What do you say? Explain your answer. First of all, why do you say false?
The without regard, then the for profit is looming.
Well, okay. If you are a partner, are you gonna care more about the success of the venture than if you're acting as some outside person?
Yes, sir.
Okay.
Should.
All right, so why do you say it's false? I think you didn't understand the
Right,
sentence.
that's, the without.
Let me read it again,
Right.
okay? If a payment by a partnership to a partner is made without regard to the success or failure of the partnership venture, such facts indicate that the payment was made as though he was not a partner. So now are you changing your answer?
Yes, sir.
What do you think? If I'm an outside lawyer and I'm doing legal work for you, I'm drafting leases and stuff, I just wanna get paid for my legal work. Do I give a rat's ass whether your partnership takes off or not?
No.
So that makes me a stranger. I'm not acting in my capacity as a partner. Does that make sense? That's all that sentence is saying. Right? All right. One more now. True or false? No gain is recognized on the sale of property between a partnership and a more than 50% rent. No, that's not the right. All right, let me just do this last, so I can do two questions with one set of facts. Let's do this, and then we're gonna call it a day. And good luck to you on your exams. And by the way, please take your exam during the time window that I have allotted for you, okay? So you have, starting tomorrow all the way to midnight, July 4th. We virtually went through almost the entire test except for the last few questions, so if you understood the lion's share of what I said today, you're in pretty good shape. For the areas that you're not all that familiar with, problems that you didn't do, I would go back to the examples I gave you in your homework and study those that deal with those issues. A lot of times I was using the same examples in today's class presentation. We have class next week, by the way. Right? Then we're going to start talking about the second half of the class, the second half of the course, where we're going to be concerned about the end of the partnership's life, where we start all the special rules regarding distributions. Distributions to a dead partner, distributions when partnerships are liquidated, distributions to withdrawing partners, special situations of transactions between the partner and the partnership, et cetera, et cetera. All right, here are the facts of the last problem. Okay, we got A and B are equal partners. A contributes cash, 10,000. B contributes property. Has a fair market value of 10 and a basis of 6. Okay? Both partners took distributions of 4 each during the year. And the partnership accumulated or increased its liabilities. It borrowed money. Of a total of $2,000. Those are the transactions during the year, and then at the end of the year, the partnership incurred a $14,000 loss, which is shared equally by A and by B. How much can A deduct of his share of the loss? How did you calculate that?
The 10 minus the 4 distribution, plus
These 6. Okay.
plus $1,000 of debt.
Oh, he gets 50% of that.
Yeah.
Correct.
So does this person over here, right? So he's got 7,000 in basis, right? Just enough for him to take his loss. All right. Same question for B. You want to try that? So basically what I'm asking you to do is to calculate B's basis. What is B's basis in his partnership interest before deducting the loss? You start with 6 minus 4 plus 1 is 3. How much can B deduct? Leading the back corner. 3. Because it's limited to basis, right? Alright, should we call it quits or you've got enough? Okay.